All right, everybody, there's nothing like having to do this a second time. So welcome to portfolio update number 17. Yeah, that's right. I did this yesterday and all of the video had some technical problems. So we're reshooting it. At any rate, the portfolio last month was sitting at $401,000. And this month we're sitting at $423,242. Now, I shot this yesterday, which was the end of September. Today is actually October the 1st, but I'm using all the numbers from yesterday, so don't fret. And I really apologize for not being able to get this video out when I wanted to, but that's the nature of things. So let's face it, guys, markets have been on a tear lately. And so all these big changes in my portfolio are great. But I think the reality here is that while things are always going up, market trends tell us that there will be a downturn at some point. So I'm wondering myself if this recent Bank of Canada rate cut is signaling some stuff in the markets that we might see a downturn. But of course, the big question is, what do you do when that happens? How are you going to handle it? Are you ready for it? I think I am. And today we're going to go over the whole portfolio, see how it's performing like we normally do. For those of you that are new here, my name is Darren. I'm a regular Canadian who used to think that it was too late to start investing, but I started investing anyway at the age of 50, and I'm proving every single day that it's never too late to build wealth. Now, in that time, I've learned some very valuable lessons, and I think they're important to understand. Number one, you gotta be consistent with your investing. What do I mean by that? Pick an amount you're going to invest. I like to use that 20% rule of your income you invest. That could be $25 a month for you guys. It could be $100 or whatever the case may be. Pick an amount and be consistent. And then what I've done is I've taken my investing amount and I've grown that each and every single month or year, depending on how much extra income that I make. I've said in previous videos that I noticed about 80% of people that are watching my videos are not actually subscribed, and it's actually a free way to help out push the channel out. All you got to do is hit subscribe. It only takes a second. Even share or like a video. But what's interesting is since I've been pointing this out to you guys, I've actually noticed that we've actually had more subscribers. And more subscribers means that the videos get pushed out to other people. And what I love is I'm seeing comments from people that they've discovered the channel and they're feeling motivated, which was the whole goal for why I started sharing my journey at such a late period of my life. So for those of you that actually take the time to hit subscribe, I really appreciate it. Thanks so much. But by sharing it, I think you're actually helping push it out to other people so that they can get motivated. The next thing is you got to be diversified in whatever you're investing in. In other words, don't just put all your money in one place. For instance, if Bitcoin's taking off, don't stick all your money in there. You want to diversify yourself. So for me, I chose ETFs for the most part. And of course, I invest in North America, in Canada, and around the world to keep myself diversified. So when one area is doing well and another one's not, it balances itself out over time. The other thing that I've learned is that you don't want to panic when the news starts to show signs of maybe things not going well. For instance, back at the beginning of the year when Trump got in, my portfolio took a real kicking, down $30,000. Now, in my investing career, this was the first time that this ever happened, and man, it was pretty freaky. But what I learned is you'll come out the other end of it looking okay. Markets always bounce back. So if we step back and look at time, we'll see that things are actually going to turn themselves around. So don't panic when you see those downturns in the market. Stay vested. Some people would argue that at that time, some of the stocks or ETFs you're investing in are actually, on sale. I don't know if that's the best way to describe it, but at the end of the day, just keep doing what you're doing. That goes back to the consistency. And the last thing is to let compounding work for you. The more you add, the more compounding works for you. And to this day, I've always been very amazed how it works for our portfolio as it grows. Of course, after we got past that first $100,000, it starts to grow quite a bit more. But for everyone, you're going to be starting at a different point. Now, don't fool yourself. There's no free lunch here. So when my portfolio went down $30,000 at the beginning of the year, that was quite a shocker. And to put that in perspective, that's like going to the car lot, buying a brand new car and driving it right over to the junker and putting it in the crusher and out the door. But here's the thing, if you keep that going, again, it will bounce back for you. So hang in there when those market downturns happen, and things are gonna bounce back for you. All right, so this is a good time to let you know that when we go through this, you're gonna see me using a couple of different tools. One is passive, that helps me track all my dividends, set asset allocations, and so on and so forth. And the other one that I'm going to use is Wealthica. Wealthica gives me an overview of my entire portfolio, and I use them together. And the reason Wealthica is nice is because I can see all the positions all together, all time. So they complement each other. So we're going to start off with my financial freedom calculator. Now, I have access through work, through Enriched Academy, but there are other ones out on the internet, and you can use any of them. But what's nice about it is after you put in all the metrics, it tells you how much money that you're going to need in the future when it comes to your retirement. So for those of you that haven't been following me, what happened with us was I realized that we probably weren't going to have enough even though I had a pension, because we do have some kids. This tool really helped me. So the goal I had set was $500,000, and based on the metrics that I put into it, the calculator is telling us that we need about $577,000 to maintain a income during retirement that we chose. Now, we're well on our way there. So using passive, we're 85% of the way there, which is pretty cool. Now, if we keep up at the current investing amounts, we're going to exceed $1 million in 8 years when I retire. I don't know how realistic that will be over time, because we may dial that back once we hit that $500,000, or in this case, $577,000 mark. But time will tell. We'll see, because every year, most people are making a little bit more money than they did last year. And so again, I use that 20%. So I'm going to invest that extra, that 20% of my check. If next year that 20% slightly more, then we're going to see a little bit more growth. So I'm hoping that within the next year, we're going to hit that benchmark much faster than I hoped. So stay tuned so we can see where that's going to go. Now, if we keep at the current trend, we can see that the surplus will be about $455,000. So we'll have to see. Now, the other thing that I like to talk about is you need to have a good relationship with your money. Don't make complete sacrifices as you go along so that you can't enjoy your life. Now, we had some catch up to do, but if you balance things against your paycheck and only put in a certain amount, in my case, like I said, it's 20%, and enjoy your life as you build up to your retirement. Don't save it all and wind up in retirement not being happy because all that time you were being so frugal. Find a good balance between now and when you get to retirement. Now, when we use passive, passive actually has a free version, and it also has a paid version. If you're a Questrade user, that paid version that's called Elite is actually free if you use Questrade, which I do. If you don't, it's $99 a year, but if you use the link in the video description below, you will get a savings if you decide to use the Elite version. But like I've said in many videos, if you use the free version, it's just fine. It does help you track some of the things that you want, but if you want those extra metrics, then you should probably look at that Elite version, but that's completely up to you. The nice thing is that if you use the link, you are helping support the channel, which brings me to a point where a lot of channels that I see have sponsors from various fund managers. And for me right now, I don't want to take on those sponsorships because I don't want my viewers to feel like I'm representing, those different funds. What I would prefer to do is just share the info, and if you decide to use these links, you're helping support the channel. There are other links in the video description, so make sure you check those out. That would be for Wealthsimple or Questrade if you're looking to use those, or EQ Bank if you're making a change in your banking. And of course, I have one that's Buy Me a Coffee. So in these videos, I go over all of the portfolio. Now, I'm only making contributions to certain accounts. So we look at the overall amount, which we already introduced in the beginning, that 423,000 mark. And then we're going to go through some of the metrics that we have going on. And one of the things that I wanted to show you guys is that the consistency in investments. And one of the little things about passive that doesn't really work too well. So in passive, you're going to see a big spike in my metrics that I have. It shows I made $115,000. Well, I didn't put that much money in. What happened was we transferred money from Wealthsimple over to Questrade to take advantage of an offering they had. And of course, that didn't actually go very well, but at the end of the day, one of the things passive can't do is it can't see that you just transferred money. It thinks that you actually made an investment. So if you look as I'm clicking along here, you're just going to see that there is some steady contributions to my portfolio, with the exception of that one big spike. So it does kind of throw some of the metrics off, but you can see a steady increase in those over time. Okay, so the first thing that I like to show is the performance over the last month. Again, this is a great part of passive, is you can actually select what you want to look at, whether it be 1 year, year to date, all time, or a specific period of time. So for the last month of September, we contributed $5,114 to this account. And of course, the net change in the account and the other metrics are not going to be accurate because of that big spike, which appears to be a contribution. So as far as dividends go, in the month of September, we earned $1,522 in dividends. And you can see all of the dividends are these lines where they all came from. We didn't pay any fees or commissions. Now looking at all-time returns, we can see that in the chart here, the green line represents the growth of the fund and the blue line represents our contributions. Now, because of that spike, it's taken a while for the contributions that I'm making and the growth of the account to catch up to each other, but we finally passed the blue line now. So standing back, looking at the portfolio from the beginning, we can see that we're earning an average of $664 in dividends every month. And we have this nice chart. If we go all the way back to April of 2023, when I was earning $1, and then we fast forward all the way to now, where we're earning almost $1,500 in dividends. That's that steady growth. Now, one of the things that I've realized is that, you know, I'm more a growth-focused investor rather than a income investor. Perhaps when I retire, we'll look at that income. But this type of portfolio that I have doesn't generate a ton of money. Now, I do have a small amount of money, about $52,000 right now, sitting in covered calls. If you go back and watch some of my other videos, I talked about this, where I wanted to test this theory out to see how this really works. Now, we're in a really strong market. So what I'm learning is that while the returns are really good, if the market takes a huge change, these funds are going to suffer quite seriously. The income will still come, but the actual overall cost of each share will drop significantly. So for now, we'll keep doing this to see how it works out. All right, so the first account we're going to start off with my TFSA. That's the reason that I started this channel, was to show myself building it from zero to maxing it out. Now, the difference between me or someone that's older and perhaps someone that's younger is, if you're younger, you will be able to max out the amount in your TFSA much sooner than the rest of us who are older. Now, for me, I had tons of room, upwards of the max around $120,000. So right now, the asset allocation I have set up is 95% accurate. We have absolutely no cash because I always invest the money that, you know, I get in dividends. Now in this account, we're making regular contributions every 2 weeks from the paycheck. The total amount of this is now at $80,168. So eventually we're gonna max this out. I'm hoping to do that within the next year. We'll be able to get this guy maxed right out. So one thing I did introduce into this part of the portfolio in previous videos was some covered calls, like I said. And in here, the nice thing is that any income that's generated is not taxed because it's after-tax dollars. So that's HHIS, HYLD, USCL, QQCL, and TESLI. Now, I'm always curious to know what viewers think. If you've been following me for a while or you're new, I'm curious to know what you guys think of this covered call idea. Now, this is a very small percentage of the total portfolio. I was aiming for 20%. We're sitting around 12% of the whole portfolio. So it's not a great deal. And it's not generating a ton of cash, but of course, as the portfolio grows, the amount of cash that it generates is more. Of course, the downside of covered calls are the fees that are required to actually hold these. They are much higher for the purposes of generating income. And the more that I learn about them with a time horizon that I have with about 8 years left, I'm not sure that it really makes a lot of sense, but I'm going to continue pushing along with this for now just to see how things work out. And I did introduce them into our emergency fund, which I'll talk about in a few minutes here. So the next account that we're actually funding is this Spousal RSP. That's where I make the contribution. My wife takes that money out later in life. Now, for a general overview, I've talked about that idea in the past, but something that came up recently that I didn't really think about and probably should have been is the tax implications. That's equally important. So the reason that a spousal is so good is I'm deferring or giving some of that income that I make and sharing it with my wife. So ultimately, when she takes it out later, it's going to get taxed at a much lower rate. If I had to make contributions to my RRSP, that would increase my income later on in life, and I would be taxed on that because I do have a pension. So that's why I utilize a spousal. For some of you, that may or may not work for you, but it is a great tool to use this spousal. So the asset allocation here is 93% accurate. We have a little bit of cash in there that I haven't invested yet. The total value of it is now $123,479. Something important to note is that if you've been following me, you'll know that we had to replace our heat pump and our furnace, and that gobbled up every single ounce of our emergency fund. Boy, oh boy, I'm sure glad that we had that emergency fund, because if we didn't, it would have been painful. But now we have to build it back up. And so what I've done, rather than keeping that cash in a high interest savings account, I'm putting it into in my wife's TFSA in a separate account with Wealthsimple, so that we know that that's our emergency fund. And what I've done, as you'll see coming up, is I've split how we're investing it. Now, what's important about this, and the reason I'm mentioning it now, is when I was funding the spousal account, I needed to take that money that I was putting in here and actually put it into the emergency fund to build it up. And we're almost there, so eventually we'll start putting money back in here, probably within about 30 days is what I'm hoping. Now, the configuration in the spousal is slightly different because it's split between Canadian and US funds. So what I do is I use Norbert Gambit in order to convert funds from Canadian to US and invest in US funds, which is why you're seeing slightly different funds. So in my Canadian side, in my TFSA, I hold VFE, and of course in my spousal, we use VOO, which is the American version of that. They're basically mimicked. What's in Canadian funds, I now mimic in US funds in here. So IEMG and ABDV. Now I do hold some XEQT in Canadian funds. That's that all-in-one approach. Okay, jumping over to the emergency fund, we're 99% on the asset allocation that I set up. There's no cash in here right now, and we have $7,310 in here. I'm trying to get this up to $10,000. One of the other things that I'm doing with this emergency fund is there are some bills that typically come up throughout the year that we need to have some cash set aside on top of the emergency fund. One of the big ones is our property tax. Some of you may set that money aside and put it in various types of accounts, or even with your bank at your mortgage, you can do that and have it paid. But for us, I want it to work for us. So I'm setting aside that amount of money every month and putting it in this account and building it up, and then we'll take that money out. That's one of the beauties of the TFSA, is that if I take money out now, I can actually reinvest that money when next year rolls around. So it's a great tool for being able to use after-tax dollars for your benefit. So for a short period of time, it will be invested. And what I'm thinking is that, I had that money in a high interest savings account, but the interest rates have been falling. Like I mentioned in the intro, the Bank of Canada has actually cut interest rates. So as they do that, high interest savings accounts also get cut. So I figure if I'm putting money in here, then it will grow a bit more than, say, if it was in those high interest savings accounts. Now, there is a big risk to this, and I'm curious to know what you guys think. If I'm taking too big of a risk by utilizing this emergency fund into some covered calls and into VFV. And I split it right down the middle so we can see some performance metrics. Now, if the markets take a big downturn, that's going to hurt because I will have to withdraw this money if I need it. That's the difference between it not being liquid. So if it was in, say, a savings account, it's liquid. Yes, it's not earning much, but it's ready for me to use. So I'm curious. You guys tell me what you think. So in this account, right now we have, like I said, 50% is in VFV. The other 50% is in HHIS, USCL, and HYLD. Now, again, these are performing fairly well right now, and every dividend that's put back into the account, I then reinvest that back into each holding. So we'll see how this pans out over the long run. Now, if you're a little bit confused or wondering how to put the pieces of the puzzle together as far as investing goes, a great place to do that is with Blossom Social. Blossom Social is a social media app. You can download it at the App Store. You can create an account, and if you choose to do so, you can actually link your portfolio and share it with others. For me, it was like bringing the pieces of the puzzle together. And of course, I do have a link in the video description below, and if you use that link, I do get a small referral for that. So if you're interested in starting out with Blossom Social, check out the link in the video description below. So a few metrics about the emergency fund since I set it up, because I think it's kind of interesting, is we can see that we started making contributions in July. Like I said, we're trying to build up that emergency fund again. We've made $7,022 in contributions. The net change in that account is $7,308. The rate of return on the account is 8.91%. So that investment growth right now is $286 to date. The average monthly income from dividends right now is $13, but of course we're coming up to the 8th when these pay out again, so this month will be more, and as we add a little bit more to this, it'll generate more. Eventually, once we hit the dollar amount that we chose, which is about $10,000, the growth will slow a bit and will only come from the dividends that are there, but again, that's the whole idea about testing this out to see how it works. The only other account that I've been funding is my Bitcoin. I started investing in it several months ago. Very, very small amount. I was doing basically $1 a day. I changed the methodology behind that recently, where I'm actually adding $10 every single week. The reason for that is that while Wealthsimple allows me to invest every day, it doesn't allow me to deposit money on set it and forget it kind of thing every day, so I have to do it once a week. So I've set it up to invest every single week, and it's automated right now. I don't even have to worry about it. It's just going to continue to grow. So that account has about $127 in it right now, and of course that will grow over time. It's a very, very small part of the portfolio, but I want to see this grow over time because I don't think that Bitcoin is going to go away. Okay, so let's look at some of the changes that we made in the portfolio this month. So the first one was in the Spousal RSP. I sold off all the HYLD.U, which totaled about $1,600, and I invested that into VOO. I felt that that would be a better play than the covered call because the covered call may not perform as well, and I felt that VOO was performing really well. I also did the same thing in my own RRSP. I sold off all my HYLD.U, and I turned around and I invested that into VOO as well. And the last big move was in my wife's RRSP. I sold off the HYLD.U and then invested that into VTI. So VTI is the total US stock market. So in the portfolio, I hold the total US stock market in VTI, and then I hold a more concentrated version, which is VFV and VOO. And then, of course, I also hold the NASDAQ 100 with QQCL. And I mirror that with the covered calls as well in the smaller part of the portfolio. I really wanted to introduce a broader part of the US market, including all of the stocks, not just the 500. So if you're sitting on the sidelines wondering whether or not you should start, I did a video recently when I talked about why you shouldn't do that and how much it's going to cost you. So if you're curious, you should check that video out right here.